Hey everyone, and welcome back. I love it when you send us stuff to dig into, so big thanks to everyone who sent over these articles comparing the 1929 crash to the economy today.
Yeah, we got quite a stack this time.
We did. And I gotta admit, just glancing through the headlines, some of them are kind of scary.
I can see why you'd say that, but hey, that's why we do these deep dives, right? To
Yeah.
really unpack these complex issues and hopefully learn something along the way.
Right, like are we really on the verge of another Great Depression? Let's find out.
Exactly. And the best way to understand where we might be going is to understand where we've been.
Okay, so first up we have this article by economist Charles Kindleberger from way back in 1983.
Ah, Kindleberger classic.
Right. He wrote this piece for Challenge magazine, and it basically lays out 10 lessons from the 1929 crash.
And what's interesting is how many of those lessons still resonate today. Like, it's almost eerie how some of the patterns are repeating themselves.
Yeah. Like Gillenberger talks about this thing called overtrading, which is when investors get a little too excited about certain assets.
Right, like too much speculation in a particular market.
Exactly. And he points out that before the 1929 crash, there was all this frenzy over bonds in 1928 and then stocks in 1929.
Yeah, sounds familiar right
Hey,
now.
like, haven't we seen that recently with things like the real estate market
Mm.
or certain tech stocks?
Oh, absolutely. And let's not forget the whole cryptocurrency craze a while back.
Oh, yeah. People were pouring money into those things like there was no tomorrow.
And it's that classic pattern, investors chasing returns, getting caught up in the hype, and sometimes forgetting about the underlying risks.
Okay, so then Kindleberger brings up this other factor that played a role in the 1929 crash, a sudden halt in lending.
Oh, yeah, that's a big one.
I mean, it's like someone just slams the brakes on the entire financial system.
Right, and Kindleberger really emphasizes how devastating that can be. Like, businesses can't get the loans they need to operate, consumers pull back on spending, and it just creates this downward spiral.
Now that you mention it, do you remember when something like that happened recently? It felt like the whole economy just froze up for a while.
Hmm. Yeah, there were definitely some moments in the past few years where credit markets got really tight and things started to feel a little shaky.
Another thing Kindleberger highlights is how people tend to dismiss the importance of price changes. Like they just think, oh, it's just a number going up or down.
Yeah, but he argues that ignoring those price signals can be a big mistake.
He specifically points to the sharp drop in commodity prices in 1929 and says that played a significant role in deepening the depression.
Which makes sense, right? Because prices are more than just numbers. They reflect supply and demand, and they can tell you a lot about the overall health of the economy.
Okay, so this next one from Kindleberger is a bit of a head scratcher. He argues that flexible exchange rates, which most people think are a good thing, can actually make things worse.
That's interesting.
Right. He says they amplified deflation in the 1930s and fueled inflation in the 1970s.
Yep.
Like they can magnify whatever economic trend is already happening.
Well, it just goes to show that there are no easy answers in economics. What might be helpful in one situation could backfire in another. And it highlights the importance of really understanding the potential consequences of our policies, both intended and unintended.
Absolutely. Okay, so let's shift gears a bit and jump ahead of a few decades to a 2004 article from Financial History magazine.
All right, what do we have here?
This one's by Richard Silla, and he's reevaluating the 1929 crash 75 years later.
75, yeah, that's a lot of hindsight.
Right, and what's interesting is that Silla doesn't think the crash itself was the sole cause of the Great Depression.
Oh, so what does he say caused it?
Well, he puts a lot of emphasis on the policy decisions that were made afterward. Things that he argues actually made the situation much worse.
So it's like the crash was the initial shock, but then the way the government and financial institutions reacted turned it into a full-blown crisis.
Yeah, that's a really interesting point, and it makes you wonder if we're making similar mistakes today.
Right. Are we learning from the mistakes of the past, or are we setting ourselves up for another major downturn?
And Till also points out something else that's kind of surprising. He says the stock market actually had a pretty big rally in early 1930 before it tanked again.
Really? So even when things seem to be getting better, it's not always a reliable indicator of long-term trends.
Exactly. It's a reminder that we can't get too caught up in those short-term market fluctuations. We need to be looking at the bigger picture, the underlying economic fundamentals.
I like that the bigger picture. Okay, so are we going to talk about those fundamentals?
We are. And that brings us to another article from that same issue of Financial History magazine. This one is by William Groover, And it caught my eye because he argues that current market conditions look a lot like the 1920s.
Ooh, now that's a bold statement.
Right, and he thinks this could be a sign that we're in a bubble.
A bubble, huh? Well, let's hear it. What makes him think that?
He lays out 4 key factors that he sees as being similar to what was happening in the 1920s. The first one is a laissez-faire government.
Ah, so a hands-off approach to regulating the economy.
Yeah, basically letting the markets do their thing with minimal intervention. And it makes you wonder, is that still true today? I mean, there have been some interventions and regulations, but is it enough to prevent a potential bubble from bursting?
Yeah, that's a good question, especially considering how much the financial landscape has changed since the 1920s. Okay, so what's the second point?
His second point is about the level of borrowed money in the markets, specifically something called margin debt.
Ah, margin debt. That was a big issue in the 1920s, too.
Yeah, basically, investors were buying stocks with borrowed money, betting that prices would keep going up. But if those prices drop, they're left with a pile of debt and potentially huge losses.
Yeah, that can get really dangerous really fast. And it feels like we've seen a lot of that kind of risk-taking in recent years.
Right, like people using leverage to try to maximize their returns.
Exactly. And that kind of behavior can inflate a bubble even further. Okay, so what's Groover's third factor?
The third factor is low interest rates.
Oh, yeah, that's a classic bubble fuel.
Right. When interest rates are low, it's cheaper to borrow money, which means more money floods into the markets, pushing prices up.
And then those rising prices encourage even more borrowing and investing, which creates this kind of self-fulfilling prophecy where everyone thinks prices will just keep going up forever.
It's like a game of musical chairs where everyone's scrambling for a seat when the music stops.
And someone's always left standing right. All right, so what's the fourth factor? What else does Groover point to?
His fourth point is about the level of public participation in the market. He sees widespread involvement as a potential warning sign, especially when it feels like everyone's suddenly become an expert investor.
Yeah, I can see that. Like, when everyone and their grandmother is talking about the stock market, it might be time to take a step back.
Remember the whole meme stock craze a while back? It felt like everyone was suddenly a day trader.
Oh, yeah, that was wild. And while it's great that more people are interested in investing that kind of frenzy, can also be a sign that a bubble is about to burst. Like when everyone's piled into the same assets, there's not much room for prices to keep going up.
Right. So we've looked at these echoes of 1929, these potential warning signs in today's market. It can feel a little overwhelming, right?
I know what you mean. But the goal here isn't to scare anyone. It's to help us understand the situation so we can make informed decisions.
Exactly. And we're just scratching the surface here. There's so much more to explore and unpack.
Right, and we'll do just that when we come back for part 2 of this deep dive. So stay tuned.
Okay, so where were we? Ah, yes, bubbles and potential warning signs.
Right. And remember we were talking about William Groover's article from Financial History magazine.
The one where he compares today's market to the 1920s.
Exactly. And one of the things he points out is that some of the factors that contributed to the 1929 crash might actually be present today.
Like those 4 factors he outlined.
Right, like a laissez-faire government approach, which basically means less regulation of the markets.
Exactly. And you know, it's interesting to think about whether that's still the case today. I mean, sure, there have been some regulations put in place since the 2008 financial crisis.
Right, like Dodd-Frank.
But are those regulations enough? Or are we still too vulnerable to another major downturn?
Yeah, it's a tough question. And it really depends on who you ask.
Groover's second point was about all the borrowed money in the markets, that margin debt.
Ah, yes, where investors use borrowed money to buy stocks.
Which can be super risky, right?
Yeah.
Because if the market takes a nosedive, they're left with a ton of debt.
Exactly. And it's not just individual investors doing this either. We've seen a lot of companies taking on huge amounts of debt as well.
Yeah, which can make them more vulnerable to economic shocks.
Absolutely. Okay, so what was Groover's third factor? It was low interest rates, right?
You got it. And this one's kind of a double-edged sword.
How so?
Well, on the one hand, low interest rates make it cheaper for businesses and consumers to borrow money, which can stimulate the economy.
Right. It encourages spending and investment.
Exactly.
Yeah.
But on the other hand, low interest rates can also lead to asset bubbles.
Because when money is cheap, people are more likely to chase returns and invest in riskier assets.
Which can inflate those assets beyond their real value.
Right. Creating a bubble that's just waiting to burst.
And Groover's fourth factor was about how many people are participating in the market.
Ah, yes. The idea that widespread involvement could be a sign of a bubble.
It's like that old saying, when the shoeshine boy gives you stock tips, It's time to sell.
Exactly. It's kind of a contrarian indicator.
Right. Because when everyone's already in the market, there's not much room for prices to go up any further.
And that can create a situation where a small dip in the market can trigger a much larger
Yeah,
sell-off.
like a domino effect.
So Groover's argument is basically that we're seeing some of these same warning signs today that were present in the 1920s.
Right. Which doesn't necessarily mean we're headed for another Great Depression, but it's definitely something to keep an eye on.
Absolutely, and it's a reminder that history can often rhyme even if it doesn't repeat itself exactly.
Okay, so we've talked about the potential risks. Let's shift gears a bit and talk about what we can do to mitigate those risks.
Sounds good. I'm all ears.
Well, one of the most important things is to stay informed.
Right, knowledge is power.
Exactly. And it's important to remember that the economy is a complex system. There are a lot of different factors at play.
So don't just rely on one source of information.
Right. Read different perspectives, talk to experts, and try to form your own opinion.
And don't be afraid to question the conventional wisdom.
Another important thing is to diversify your investments.
Ah, yes, don't put all your eggs in one basket.
Exactly. Spreading your risk across different asset classes can help protect you from major losses.
And it's important to have a long-term perspective.
Right. Don't get too caught up in the day-to-day fluctuations of the market.
The market goes up, the market goes down, but over the long term, it tends to trend upwards.
And remember that investing isn't just about making money. It's about achieving your financial goals.
Whether that's buying a home, retiring comfortably, or leaving a legacy for your family.
Okay, so we've talked about some of the things individuals can do, but what about the government? What role can policymakers play in preventing another major economic crisis?
Well, there's a lot of debate about that. But I think most economists would agree that sound fiscal and monetary policies are essential.
Right. Fiscal policy refers to the government's spending and taxing decisions.
And monetary policy refers to the central bank's control of the money supply and interest rates.
And these policies can have a big impact on the economy, both in the short term and the long term.
Absolutely. For example, during the 2008 financial crisis, the government and the Federal Reserve took a number of steps to stabilize the economy.
Like the Troubled Asset Relief Program, TARP,
Mm.
and quantitative easing, QE.
Right. These programs were controversial, but they helped to prevent a complete collapse of the financial system.
And it's important to remember that those interventions came with a cost.
Oh, definitely. Like
Yeah.
increased government debt and the potential for inflation.
Right. So policymakers have to carefully weigh the costs and benefits of different interventions.
And they need to be prepared to act quickly and decisively when a crisis hits.
So it sounds like there's no easy answer to the question of whether we're headed for another Great Depression.
Right? There are a lot of factors to consider, and it's impossible to predict the future with certainty.
But by understanding the past and being aware of the potential risks, we can make more informed decisions and hopefully avoid making the same mistakes again.
Exactly. And I think that's a good note to end on.
I agree. Thanks for joining us for this deep dive into the 1929 crash and today's economy.
It's been a pleasure as always.
And we'll be back soon with more fascinating deep dives into the world of economics and finance. Stay tuned.
So much to think about, huh?
I know, right? We've covered a lot of ground in this deep dive. It's kind of like we took a time machine back to the 1920s.
And then fast forwarded to today to see if we're making the same mistakes.
Exactly. And, you know, it's easy to get caught up in all the doom and gloom, but I think it's important to remember that we're not powerless.
Right. History doesn't have to repeat itself.
We can learn from the past and make better choices for the future.
Absolutely. And I think that's where the real value of these deep dives lies.
It's about empowering ourselves with knowledge so we can make informed decisions.
Whether it's about our personal finances or how we vote.
Right. Because ultimately, we're all in this together.
We are. And the more we understand about how the economy works, the better equipped we'll be to navigate the challenges ahead.
So what are some key takeaways from our deep dive into the 1929 crash and today's economy?
Well, I think one of the biggest takeaways is that excessive speculation can be really dangerous.
Like all that overtrading Kindleberger talked about.
Right. When investors get too caught up in the hype, they can lose sight of the underlying risks.
And that can lead to bubbles that eventually burst.
Another takeaway is that policy decisions can have a huge impact on the economy.
Yeah. Scylla made a really compelling argument about how the policy mistakes made after the 1929 crash actually made the Great Depression much worse.
Exactly. So it's crucial that policymakers learn from those mistakes and implement sound fiscal and monetary policies.
And I think Groover's article really highlights the importance of being aware of potential warning signs. Like those 4 factors he outlined.
Right. Things like a laissez-faire approach to regulation, excessive margin debt, low interest rates, and widespread public participation in the market.
Those are all things we should be paying attention to.
Absolutely. And if we see those warning signs flashing, it might be time to take a step back and reassess the situation.
So where do we go from here?
Well, I think the most important thing is to stay informed.
Right. Read different perspectives, talk to experts, and try to form your own opinion.
And don't be afraid to challenge the status quo.
Exactly. The economy is constantly evolving, and we need to be adaptable.
And remember, knowledge is power.
The more we understand about economic history, the better equipped we'll be to navigate the present and the future.
Well said.
That's it for today's deep dive. Thanks for joining us, and remember, stay curious, stay informed, and don't be afraid to ask questions.
And until next time, keep on learning.